Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Apple's Q1, the quarter that most positively surprised me so far. Upgrade. This article was written by Kenio Fontes. Apple Inc. delivered a surprisingly strong fiscal Q1, with 16% year-over-year product revenue growth and a $5.2 billion revenue beat. iPhone sales surged 23%, driving all-time highs and expanding the active device base to 2.5 billion, signaling renewed ecosystem momentum. Gross margin expanded to approximately 48%, supporting 18% year-over-year operating income growth despite a product-heavy revenue mix. I upgrade AAPL stock to hold. Valuation is now fair but not compelling, and heavy buybacks at high multiples remain a concern. One of my concerns with Apple Inc. AAPL, which led me to give it a sell rating recently, was its lack of innovation, which in turn impacted top-line growth and my expectations for valuation. For me, it is very difficult to justify a high multiple for a company that was growing at very mature rates and did not seem to care much about investing in innovation, prioritizing things like buybacks, which is not exactly bad, but I will explain later why I don't like it so much. But Apple's fiscal Q1 showed me that I was at least partially wrong. I didn't expect anything like this. Revenue growth wasn't just good, it was absurd, and of course operating income followed suit. That said, I consider myself only partially wrong, as the market reaction wasn't as good as I expected. When I saw these numbers, I thought AAPL stock must be up about 10%. But no, at least so far, it's flat. This shows that the valuation really wasn't the best and didn't allow for such a high upside, even with so many positive surprises. Anyway, this new momentum is enough for me to upgrade to hold. Apple's fiscal Q1 impressive, that's it. Before Q1 came out, I was running some scenarios for Apple in Excel, and I considered a 10% revenue growth for products, assuming a positive cycle scenario. Basically, it was something for me to think this probably won't happen, but what if a new cycle begins? Well, what Apple showed now was a 16% year-over-year growth in product revenue, believe it or not, growing more than services. For me, it was really surprising. iPhone sales were way off the curve, and not even the market expected anything close to that. Revenue estimates were already positive, but the company managed to exceed them by $5.2 billion, a 4% beat considering the midpoint, which for a company like Apple that is so closely followed not only by analysts, but also by various other types of markets, with so much information available, and already has revenue of $140 billion per quarter, is really impressive. In fact, CEO Tim Cook himself said that this revenue growth was well above Apple's expectations. EPS was also a reasonable beat, 17 cents, which is approximately 6%. If you usually read my other analyses, you know what I usually look at. Much more important than EPS growth is whether this improvement in revenue was sustainable, that is, what is behind these numbers. And that also made me more optimistic about the case. As I mentioned, iPhone sales were great, and that was a highlight in the release. The company mentioned that iPhone revenue was at all-time highs, which with 23% growth was to be expected, and the justification for such good growth was unprecedented demand. The company also mentioned that there are now 2.5 billion active devices. For me, that's enough to believe that momentum is improving. This growth wasn't something like people loved feature X or Y of the iPhone 17. For me, it's something beyond that. It's a sign that the cycle is turning. More people are now locked into the Apple ecosystem. People who owned iPhones such as the 11, 12, and 13 are now feeling a greater need to upgrade, whether because of a deteriorating battery or an outdated camera. And this may have been further catalyzed by trends such as countries like India and Brazil seeking more premium devices. And that completely changes the game. More devices means more services, meaning that someone who bought an iPhone now may buy a Mac and an iPad in a year's time, and help these two revenues that lagged behind this quarter. In fact, iPad revenue was interesting this quarter, growing 6% year over year. And although this is much worse growth than consolidated revenue, it was better than the Mac, which fell 7%. Another point I found very interesting about Q1 is that even with the mix more focused on iPhones, and consequently fewer services, the gross margins still expanded, going from approximately 47% to approximately 48%. For this reason, operating income grew slightly more than revenue, with 18% year-over-year growth. Apple's valuation acceptable, but still not good. After this very strong quarter, I adjusted my assumptions slightly. Now, Apple's valuation seems a little more acceptable, but it is still not the best. I assumed a 12% revenue growth for products by 2026, driven mainly by iPhone revenue in this quarter, which I imagine should remain at a better momentum throughout 2026, gradually declining until 2030. For services, I maintain stagnant growth at 10%, but with 15% year-over-year in 2026 and 2027 due to the larger device base. As efficiency and operational leverage are still having an impact on margins, as well as the better revenue mix returning to services in the coming years, I maintain the net income margin growing, but only a few bips per year. With that, I still find a PE of 25x for Apple in 2028. It's not great, but as the company is growing, we may have some positive surprises along the way, such as product revenue maintaining this high single-digit revenue growth for longer than expected, which seems more acceptable to me. But even so, it doesn't seem enough to me for a buy rating or to be extremely optimistic about the company. I don't think there is such a significant asymmetry, since even if this revenue growth continues, it will still take a few years for the company to return to trading at multiples that allow us to glimpse such a high upside, such as 20 times earnings or less. For this reason, I don't think it's an ideal valuation for so many buybacks, and I would honestly prefer to see the company show that it can still allocate resources to other ways of expanding the business. But I understand, they are disciplined with cash flow, and in some ways, it's even interesting to avoid burning money on promises that could go wrong. Why I don't like Apple's buybacks. Note that I didn't say I don't like buybacks. I think it's an interesting way to remunerate shareholders, but I think that, especially when it comes to Apple, it's not such a simple equation. It's not like a dividend or normal remuneration. Market. A bit of a myth has been created that buybacks are a very good way to remunerate shareholders, and this also ends up helping some companies maintain a positive public perception. Basically, even if the top line isn't that good, the EPS looks super interesting, and in the end, that's the KPI that many will look at anyway. So you see that Apple is growing its EPS by 18.3% and think that's great, but you have to remember that part of that is shareholder remuneration, not improving fundamentals. But as I mentioned, this quarter was very good, with net income, which would be a fairer metric, still growing by 15.9%. However, note how this depended on growing revenue, operating leverage, and everything else, and not just fewer shares outstanding. It's not great. The growth you're seeing in EPS is basically being inflated with your own money. What I mean is that what could have been dividends was buybacks, and it doesn't reflect how interesting the growth is at the moment. And the point I find most controversial about buybacks is the timing. If Apple were trading at historical low multiples, I would think buybacks were great. Apple's treasury buying AAPL stock at 15x earnings is great. They are basically saying that they believe in the company's potential, and the perception that this will be a good deal in a few years is much clearer. They are buying a company with an earnings yield already well above 5% and with an IRR in the high single digits or low double digits if growth is healthy. But when Apple is buying back stock when the multiple is 30x, I find it strange. A buyback here and there, okay, that's part of it, but most of the remuneration being buybacks is strange to me. We are talking about a company with a compressed IRR. It's as if Apple were saying, we haven't found anything more attractive to invest in. There's no new revenue stream to be built. Nothing that gives a higher return than buybacks. And the implied return on the buyback, in my view, is currently low due to the valuation. Another thing that needs to be mentioned is that this high flow of Apple's own repurchases has a positive effect on the stock's momentum. But what about when they decide to reallocate to something else? Will this increase or significantly trigger selling pressure? In the end, it seems to me that repurchasing many stocks at this valuation is more of a bad sign than a positive one. This is also related to my latest analysis, where I mentioned that one of my concerns is precisely this innovative part of Apple and how it can affect growth structurally. Using Q1 as an example, we are seeing a company that generated more than $50 billion in operating cash flow, driven by changes in working capital, depreciation, and stock-based compensation, or SBC. And of that amount, $2.3 billion went to CapEx in the acquisition of property, plant, and equipment. $3.9 billion went to dividends, and $24.7 billion went to repurchases of common stock. This seems very discrepant to me. Comparing this to R&D, okay, the company significantly increased its investments in R&D, which is a positive thing, but the expenditure was $10.8 billion, less than half of what it spent to repurchase its own overvalued stock. In short, the chart below is indeed very attractive, but it should be analyzed with caution. The bottom line, as I was writing this article, Apple's after-hours trading improved slightly, but the market still reacted with 1.2% gains. That seems very little to me considering such a strong quarter. But this may also have to do with valuation. As I mentioned, even with this growth, the valuation is now more reasonable and fair than really attractive. Therefore, I am upgrading my AAPL rating to hold. This article was written by Kenio Fontes. ASML Q4 Preview AI Momentum.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.